Welcome to Investors Guide. You're watching ET Now. Thank you so much for tuning in. Now, I know Diwali is over and that's a little disappointing, but on this show, all year round, we spend our time trying to make you more prosperous and more wealthy. All you need to do is give us the next half hour. Now, I want to remind you that coming up over the next couple of weeks, we're planning a special show for our retired viewers. So if you're a senior citizen and you want help with your finances, feel free to write to us. Our email ID is at the bottom of your screen, and we'll be glad to take your question on the show. And remember, if you're a woman, retired, and you want some help, you will be specially partial to a question that you send in. Let's get straight to it. On the show this week, if you're retired and you prefer to use mutual funds as an investment, we'll take a look at the funds that suit you best. In our product review, we look at the L&T India Large Cap Fund, and we'll find out if the shift from Fidelity to L&T has made any difference. And we'll also tell you where you can invest to create a corpus of 2 crore rupees. Our first question comes in from T. Sridharan. He's a retired Air Force officer, Dhirendra, with a portfolio of 12 lakh rupees invested in mutual funds. Now, he'd like to continue these investments for the next 5 years. Now, we can assume, of course, since he's a retired officer with the Air Force, that he has both insurance and a pension coming in from the forces. So, I would assume here that he doesn't need these funds to give him a monthly income. Interestingly, for someone with a pension, he's doing a monthly SIP. Now, before we get into whether or not that's a good idea, I want to give you a list of the funds that he has. He's not very happy with how his equity funds are performing, although they do seem like a good list of funds. He has the DSP BlackRock Top 100. He has the ICICI Prudential Focus Blue Chip, IDFC Premier Equity, HDFC Equity, and HDFC Prudence. He also has a very long list of debt funds. There is a Dynamic Bond Fund, a Cash Management Fund, a Super Saver Income Fund, and the Reliance MIP. Topped all of that off with a Reliance Gold Savings Fund. Now, these are good funds, but it doesn't seem like he has a very clear idea of what he wants this money to do, or what he wants these funds to do for him. Would you like him to modify the portfolio that he has right now, or should he be shifting entirely to a portfolio that's easier to manage?
I think, he should just work on a simple plan, that how much money he needs in next 3 years or 4 years time. And that money should be into a fixed income fund. And one fund may be enough, at most 2 funds. If he is frozen on that time frame, and if he can match a FMP with that, that will be a good choice. If he is unable to find anything, then even a fixed deposit of that tenure or of that term should be good enough. Beyond that, I think, given his 5-year time frame, I would urge him to simplify it, build a low maintenance portfolio, target an asset allocation so that it will not cause an anxiety. It looks like, it is about 60-65% into equity, remaining in fixed income. And that can be achieved very, with great tax efficiency and great simplicity with our stable growth portfolio. That is generally a 70-30 portfolio. 70% into equity, 30% into debt, and by spreading it over 4 funds, he will be de-risking himself. He will get adequate diversification. All the return from that from that balanced fund portfolio will be tax-free, and he will be drawing from the skills of 4 fund managers.
All right, so that's very clear advice for you, Mr. Sridharan. What you need to do right now is all of the short-term money, like Dhirendra said, use either an FMP or a fixed deposit. The long-term money, which is 5 years or more, use our stable growth portfolio. It's on your screen right now. It also makes everything so much easier to manage. But Dhirendra, one of the questions he had was that if he were to pull all of his money out, or any of his money out of these funds and move it into other funds, would you like him to do a systematic withdrawal plan, or should he be doing lump sum to lump sum? What's your recommendation here?
I would urge him to, even consider moving all his money, because he is exposed to the equity risk or equity volatility anyway. He's already invested. So moving that, all his money invested into equity into a balanced fund is not a bad idea. He can well make a lump sum, because he's not taking the risk at one go. He's already exposed to equity, and he's moving into a more conservative, or maybe a balanced fund will be a more stable vehicle than his exposure to the equity funds right now.
Also, you must remember that 4 balanced funds are far more tax efficient than the combination that you have right now with all of those funds in your portfolio. Dhirendra, they're giving you a list of funds that you can use, and he said don't worry about moving it lump sum. I'm going to put that list on your screen one more time so you can write it down. And if you have any more questions about what you just heard, even if you're watching at home and this is not your question, feel free to write write to us. Our email ID is at the bottom of your screen. All right, we have another question that's coming from Vasant Direndra. He's 37 years old. He can invest 10,000 rupees a month right now for the next 10 years. He hopes for an annualized return of between 15 and 18%, and he wants to know where he can invest. Obviously, an annualized return of 15 to 18% rules out all forms of fixed income. So, should he be considering equity, and which funds would you like him to look at?
I would urge him to, consider a, fairly diversified vehicle, not a large cap fund, not a small and mid cap fund. And given his 10-year time frame, equity will be the right vehicle. And if he is, willing to settle for lower return, something like 12-13%, that can be achieved with far greater stability with a balanced fund. I would make two suggestions. One is that if he is very conservative, if he gets very upset with the value of his investments going down in a brief period of time, he should consider investing in one or two balanced funds. If he is fine with little, ups and downs, and he is not going to look at those values and get very upset, then he should consider a large and mid cap fund or maybe a multi-cap fund. And he can pick funds from our, growth portfolio for equities, and for the balanced fund from our stable and growth, stable growth portfolio.
All right, so I'm going to take you through that. This is our growth portfolio on your screen. These are the equity funds that you can choose from. Choose one or two if you have a strong stomach for the market, and you can take the ups and downs. Remember, this is long-term money. Now, if you don't want to take that kind of volatility and you'd prefer to be slightly more stable, our stable growth portfolio is on your screen. Direndra Singh, pick one or two out of these four funds and use them over the next 10 years. That should do the trick for you. We have time for one more question. P.S. Srinivasa has written in, Direndra, also a retired person. Now, he tells us he bought the Birla Sun Life Insurance Freedom 58 plan with a premium of 1 lakh rupees last year. His total investment has come down to 80,000 rupees now, and he's very disappointed with the way it's doing. He wants to know if he should continue with the subsequent premiums or should he pull his money out. Now, the Birla Sun Life Insurance Freedom 58 plan is a pension accumulation plan, and it's not suited at all for someone who's already retired. It has no life cover, and it has very high charges right now in that first year. Now, what would you recommend he does at this point? Should he at all continue with this plan, considering it doesn't really suit him?
Not at all. It is a very inappropriate, investment for a person at 60. And then he is certainly not in the accumulation phase of, for his retirement corpus. So he should just take out his policy document, the plan document, and try to find the best, the most cost-efficient way of discontinuing it.
Mr. Srinivasa, unfortunately, you have made a wrong decision with this particular investment, but it's not too late now. You have lost a little bit of money. Speak to your agent, find out how soon you can pull your money out. Definitely don't put any more premiums into this policy because it doesn't suit you. And once you manage to pull your money out, you can, of course, write back to us and we'll tell you what you should be investing in at your age. Coming up after the break, Direndra is going to stay with us and we'll talk about the L&T India Large Cap Fund. We'll find out if the switch from Fidelity to L&T has made any difference to this fund and if you should stay invested. Welcome back. You're watching Investor's Guide on ET Now. Thank you so much for staying with us. Well, it's time for our product review, and this week we're looking at the L&T India Large Cap Fund. Avan is here to give us a quick introduction. Avan.
Thanks for that, Faye. Well, after the merger in March last year, the Fidelity India mutual funds were taken over by L&T Mutual Funds, and our fund in focus this week witnessed a change in management. On November 26th last year, L&T Hedged Equity Fund, L&T Opportunities Fund and the L&T Growth Fund were merged with the Fidelity India Growth Fund, and the scheme was renamed L&T Large Cap Fund. Launched just a year before the markets hit the bottom line, this fund managed to keep its head above the water. It faced the worst period in September 2008, where it gave returns of up to a negative 51%. And later in 2009, it bounced back, leaving its investors with annualized returns of 118% that year. Despite the change in management, the fund's investment strategy has not witnessed a very large change, and the fund has managed to consistently beat its benchmark, the BSE 200. But over the course of 2012, which was a real test for all equity funds, this fund did not top the charts among the category. Let's calculate some numbers to give you a better point of view. Now, if you invested 1,000 rupees in this fund when it launched, you would have 1,360 rupees today. So should you remain invested in this fund or pull your money out? Let's find out. With that, it's back to you, Faye.
Well, Dhirendra, the last time we talked about the shift between Fidelity to L&T, you told us to wait a while and give the new team some time to show us their performance. Now, we've been watching for about 10 months. From what you've seen so far, are you impressed with the new team?
It has been quite neutral. There has been a change, and I don't think it has had a very positive or any devastating effect on these funds. I think there has been a great continuity. And the reason behind this has also been that the funds were the objective of the funds were very well articulated, and I think it will be some time where when we can say that the new fund managers are disappointing or they are very impressive. I don't think there has been enough time, but surely there has been reasonable continuity, and the characters of the fund has been maintained or they have followed it. They have maintained the style purity. So it's too early. It's still early, but I would say that this fund is looking reasonably good. It was a good large cap fund and remains one. It is not a very old fund, so but in its 5-year, last year was a struggle for this fund. Except for that, it has been able to beat its benchmark as well as most of its peers.
Dhirendra, before we move on to the ratings of this fund, could you tell us what the better options are for someone looking to invest in a large cap fund?
I like Franklin Blue Chip for its long history, and despite its recent underperformance, or not underperformance with a benchmark, but other funds doing well in recent past. Axis Equity has been an impressive one. ICICI Prudential Top 100 also looks very impressive.
All right, Dhirendra, finally, your rating of the L&T India Large Cap Fund, where would you place it?
I would assign it a 4-star, and that is where its rating is on a risk-adjusted scale too.
4 stars there for the L&T India Large Cap Fund on Investor's Guide. Let's move on very quickly to our portfolio question. All right, so Sunil Kumar has written in from Pune. Dhirendra, he's 32 years old. He has a target of 50 lakh rupees that he wants to hit over the next 15 years for his child's education. Now, he tells us he has a monthly income of 60,000 rupees and he saves a large portion of that. He already has term insurance, which is impressive, of 1 crore rupees. He has a health cover from his employer, and I'd like him to buy his own individual health cover so he's not dependent on his employer entirely. He sent in his investments. 50,000 rupees every year goes into the HDFC SL Crest Fund. Now, this fund is a ULIP with only a 10-year term, and he's paying a lot of money for it. And I'm wondering if for someone his age, at 32, buying a 10-year ULIP, does that really make sense? Would you like him to consider pulling money out of that investment?
Yes, certainly, for somebody in his age group and his time frame, he should not be accumulating his savings through a ULIP. But I would not like him, I would urge him to, have a planned exit, because when investors, when people invest, get out of an investment in a half, it might be injurious. So if it's a new ULIP, you just might be stuck for 5 years. If it's an old ULIP, and if you have paid the premium for at least 3 years, then you can plan your exit. But even after 3 years, the surrender charges could be very high. Try and marginalize your losses as much as possible with a planned exit, and certainly it's not a suited investment.
Well, he's currently investing about 7,000 rupees in his mutual funds. He tells us he can take that money up to 10,000 rupees a month. He has the IDFC Premier Equity, HDFC Mid Cap Opportunities, ICICI Prudential Dynamic, and the iProof Focus Blue Chip, Dhirendra. Most of that money, though, is going into IDFC Premier Equity. This is an impressive list of funds. Would you like him to continue with that list?
I would suggest him 2 alternatives. One is that he drops ICICI Prudential Focus Blue Chip altogether and spread his money equally in the 3 funds. The other is that, he thinks in terms of adding at least 1 international fund in his portfolio, and maybe ICICI Prudential US Blue Chip Fund, or Franklin's US Opportunity Fund could be a reasonable choice, and spread his money equally in these 4 funds. He will have diversification. He will have international diversification as well.
This is an interesting idea, to use an international fund, and considering he is investing for his child, and we have so many people who watch this show who are thinking about their children's futures. If his child grows up and at some point wants to go overseas to study, will that international fund also provide him a hedge against the dollar rate perhaps 15 years from now?
Of course, if your money is invested elsewhere or internationally or in the US, and if your child is going there, yes, you will be part of that economy. But mind you, my sense is that one should still be extremely upbeat about domestic economy simply by going by the growth rates that we witness. but it is a meaningful diversification. It is worthwhile having, and I'm not suggesting it primarily because recent 1.5 year has been good for international fund because of our currency depreciation. No, even if it is not doing very well, simply for the sake of following the principle of diversifying elsewhere, one should be investing.
All right, so you should be investing in an international fund. I'm going to give you a quick recap of the advice that Dhirendra has given you. First, consider pulling money out of that ULIP, but make sure you don't lose too much. If you have to wait a year or two, do that. Secondly, with the 4 funds that you have, you need to spread the money across those funds evenly. You don't need the focus blue chip fund. It's too much of a large cap for you. Replace it with an international fund. Dhirendra has given you 2 international funds that you can consider. I'm going to put them up on your screen right now. Dhirendra, thank you so much for answering our questions on Investor's Guide this week.
Thank you very much.
It's always a pleasure to sit down with you. Remember, if you have questions for Dhirendra, write to us. Email ID is at the bottom of your screen. When we come back, we will talk about where you can invest to create a retirement corpus of 2 crore rupees. Welcome back. You're watching Investor's Guide on ET Now. Thank you for staying with us. It's time to focus on our asset allocation. And I want to bring in my asset allocation expert, Vishal Kapoor, who joins us now. Vishal, thank you so much for joining us on the show.
Thank you.
Our first question comes in from 28-year-old Asha, who writes in on behalf of her husband as well. Now, she tells us the 2 of them want to build a retirement corpus of 2 crore rupees. They can currently save about 10,000 rupees a month for the next 20 years. Now, they had initially invested in stocks and they burnt their fingers, and now they're a little nervous about picking up stocks again. They want to know what's a good way to start right now. Well, the good thing for Asha and her husband is that it's never too late to start. Vishal, how would you like to get them started?
Asha, it's good to see that you're reverting to a mutual fund portfolio to help meet your goals. The saving objective that you have of 10,000 is a good start, but we may have to be cautious because at the current rate at which you need to grow, that would mean that you would need about 25% compounded growth for the next 20 years to achieve your objective of 2 crores of a lump sum. Now, that may be stretching it, may be a bit unrealistic. If we were to look at a more conservative return estimate of about 12%, let's say, then for doing that, you would need about 20,000 rupees of saving per month to meet your objective. Now, even when we start at 10,000, it's a good start because we know that over time, income may increase and therefore your ability to save and contribute towards an SIP may also increase. So, you could start at 10. If you can stretch the SIP amount to 20, then it's a great place. But if not, then build it up over the years. As income grows, I'm sure that you will want to save a bit more and increase your SIP. And we should be ballpark in that range, in a reasonably moderate to conservative sort of a portfolio, returning about 12% as an expected yield. If we do more than that, then that's fantastic.
Our next question comes in from Mohammed Latif. Now, he has about 2,000 rupees every month that he can set aside, and he wants to know where he should be investing that money. Now, he has 2 children who depend on him, so he's bought health insurance of 4 lakh rupees for his entire family. He's also putting 25,000 rupees into an LIC policy, although he hasn't told us which one in particular. Vishal, for the 2,000 rupees that he can save every month, where would you like him to invest that money?
Latif, it's good to note that you've got some amount of insurance cover, you've got yourself a health insurance plan, and now you're starting to build an SIP. So it's a good systematic way to build a plan. Now, since you've started, I'm going to recommend a few large cap equity funds to start with. The reason I'm doing that is because you are looking at least a 5-year time horizon and you're young. So I think once you understand a bit of the risk, you can afford to take it and gradually increase it over time. The specific funds you could look at could include the ICICI Prudential Focus Blue Chip. You could also look at the BNP Paribas Equity Fund as well as the UTI Equity Opportunity. So those could be funds that you could start with, keep it diversified and build it up gradually, and I think you should get to your objectives.
We have time for one last question, and I got a quick 1-line email from Sushil Pandey, who writes in from Delhi. He tells us that he has about 20,000 rupees in savings every month. He's looking to put it away for the next 10 years to create a corpus of about 40 lakh rupees. Now, he hasn't told us what the money is for. It doesn't seem like a very hard ask, Vishal. Where would you like him to invest that money?
Sushil, you've set a very realistic objective for yourself. So, thanks for doing that, and congratulations for having come this far. The objective that you set for yourself would imply a return on your portfolio of about just 10%. Now, 10% is a good target to have for a moderate customer or a not without taking too much of risk. So what you could do is just start into an SIP, keep a moderate profile if you're not comfortable with too much risk, and we should be able to get the return that you're targeting at about 10% compounded to achieve your goal. Monitor it regularly, because you know, the return expectations in the market do fluctuate quite a bit. If you're comfortable with more risk over time, or if your objectives do change, then you can always revisit and rebalance. All the best.
All right, that's a wrap on the show. Vishal, thank you so much for joining us and answering all of our questions.
Thank you.
If you have a question for Vishal or any of our other experts, write to us. Email ID is at the bottom of your screen. We're also planning a special episode for all of our retired viewers and seniors who'd like help with their finances. Send in a question if you want some help, especially if you're a woman investor. You know, we're especially partial to you. Thanks so much for watching Investor's Guide this week. Remember, you can catch a copy of the show on our Facebook page, and you can reach me personally on Twitter. Thanks for watching.